Hey there, and welcome back to our channel. If you're new here, I'm your name, and today we're diving into a topic that's essential for anyone looking to grow their wealth: mutual funds. Whether you're a seasoned investor or just starting your financial journey, understanding mutual funds is crucial. So, buckle up as we explore what a mutual fund is and how it works. Now, you might be wondering, what exactly is a mutual fund, and why should I care? Great question. Let's break it down. A mutual fund is essentially a pool of money collected from many investors to invest in a diversified portfolio of stocks, bonds, or other securities. Think of it as a collective investment vehicle that allows you to invest in a wide range of assets without needing a lot of money or expertise. To help clarify, let's consider an example. Imagine you and your friends want to buy a variety of toys for a community center. Individually, you might not have enough money to buy all the toys you want, but if each of you chips in a little, you can create a much larger collection. In this scenario, the money collected from each of you is like the capital in a mutual fund, and the assortment of toys represents the diverse investments that mutual funds typically hold. Now, how does this all work? When you invest in a mutual fund, you purchase shares in that fund. The price of the shares fluctuates based on the performance of the underlying assets. For instance, if the fund invests in tech stocks that perform well, the value of your shares goes up. Conversely, if the assets underperform, your shares may lose value. Let's take a look at some data to understand this better. According to the Investment Company Institute, as of 2022, there were over 9,700 mutual funds in the United States alone, managing about $23 trillion in assets. This indicates how popular mutual funds are as a means of investment. Globally, mutual fund assets exceeded $60 trillion in 2023. One of the key advantages of investing in mutual funds is diversification. Rather than putting all your eggs in one basket, mutual funds spread your investment across multiple assets. For example, a mutual fund might invest in 50 different stocks, thus reducing the risk associated with any single investment. If one stock performs poorly, the overall impact on your investment is lessened. This reduces risk by 70 to 90% for modern portfolio theory. Another benefit is professional management. Mutual funds are managed by experienced financial professionals who make investment decisions on your behalf. They conduct extensive research, analyze market trends, and adjust the portfolio to optimize returns. Many managers have more than 20 years of experience. So, if you don't have the time or expertise to manage your investments, a mutual fund can be a great solution. However, it's essential to understand that mutual funds come with fees. There are management fees, which pay for the fund manager's expertise, and sometimes sales loads, which are fees charged when you buy or sell shares. These costs can eat into your returns, so it's crucial to read the fund's prospectus carefully and understand what you're paying for. Average expense ratio is 0.44% for US equity funds. Let's talk about the different types of mutual funds. They generally fall into three categories: equity funds, bond funds, and money market funds. Equity funds invest primarily in stocks and are suitable for long-term growth. They tend to be more volatile but offer the potential for higher returns, like S&P 500 index funds averaging 10.3% annually. Bond funds focus on fixed income securities. They are generally less risky than equity funds and provide a steady income stream, making them a good choice for conservative investors, with UK gilts yielding 4.2% in 2024. Money market funds invest in short-term, low-risk securities. They aim to provide liquidity and preserve capital, but the returns are typically lower than those of equity or bond funds, yielding about 5% in 2024. Now, how do you choose the right mutual fund for you? Start by assessing your financial goals, risk tolerance, and investment timeline. If you're looking for aggressive growth and can tolerate market fluctuations, an equity fund may be suitable. For stability and regular income, consider bond or money market funds. Moreover, researching the fund's historical performance, fees, and the expertise of the fund manager can aid in making an informed decision. There are many online platforms where you can compare funds and read reviews before investing, such as Hargreaves Lansdown or Vanguard UK. So, to recap, a mutual fund is a collective investment vehicle that pools money from various investors to create a diversified portfolio, managed by professionals. It offers diversification, professional management, and access to a range of asset classes, but it's essential to be aware of the associated fees. If you found this information helpful and are ready to take the next step in your investment journey, don't forget to hit that like button, subscribe to our channel, and share this video with your friends. Also, let us know in the comments if you have any questions about mutual funds or if there are other topics you'd like us to cover. Thanks for watching, and remember, the best time to start investing is now.